The performance of the stock market is mostly influenced by the state or the condition of the economy. That's an actual fact every investor should take into consideration. And so in this video, I want to highlight how economic recessions impact the stock market, how economic recessions impact the stock market, what investors need to know, what every investor should be aware of. Economic recessions represents periods of a declining economic activity. They typically have it typically has a significant and a complex impact on the stock market. Generally, that particular impact the economy has has on the market, whether positive or negative, depending on the state of the economy. The relationship between recessions and the stock market performance varies depending on factors such as the severity of the recession, investor sentiments, and government responses to put the economy in shape. Here are recessions influence. This is how I want to highlight how recessions actually influence the market, and you want to consider this particular topic under a number of points. Number one is decline in corporate profits. Decline in corporate profits. During a recession, the demands for goods and services generally falls as consumers and businesses cut back on spending, and so this leads to lower revenue and profits for companies across various sectors. So as corporate earning declines, you discover that stock prices often follow suit, particularly for companies sensitive to the economic cycles, such as retail, travel, as well as companies within the discretionary goods sectors. Number two is market volatility. Market volatility. Recessions often lead to increased market volatility as investors react to changing economic conditions. This is typically uncertain. This is typically, there is uncertainty, about how long the recession would last and how deep it will be. Nobody can really say for sure, which of course will cause a sharp drop or cause a sharp fluctuation in the stock market. And so stock prices may swing drastically, as market participants adjust their expectation based on economic data, corporate earning reports, as well as government or central bank intervention. These are factors that would equally affect the market on its own on their own ways. Number three is investor sentiment and risk aversion. Investor sentiment and risk aversion. So during recessions, investor sentiments tend to turn negative. Fear of further economic deterioration may lead to investors becoming more risk averse, selling off stocks in favor of other safer investments. Investment like bonds, gold, or even cash. And so risk sensitive sectors like technology or consumer discretionary may suffer more, while defensive sectors such as utilities, healthcare, and consumer staples may perform better. As investors at this point would want to seek stability, in their portfolio. Number 4 is interest rates and monetary policies. Interest rates and monetary policy. Central banks often respond to recession by lowering interest rates to stimulate borrowing and spending, to stimulate consumer borrowing and spending. So lower interest rate can make borrowing cheaper for both businesses and consumers, and the more people are able to have access to cheap funds, the more they tend to spend, and the more they spend, then it would certainly impact corporate sales, corporate revenue, as well as profits. So for the stock market, lower interest rate can make bonds less attractive, leading investors to shift their capital into stocks. Additionally, lower rates can improve corporate profitability by reducing borrowing cost. Number 5 is government stimulus and fiscal policy. Government stimulus and fiscal policy. The government, often introduce stimulus packages. Generally, they inculcate tax cuts, or increase in public spending to mitigate the impact or the effect of recession on the economy. So these measures aim to support consumer spending, stimulate investments, and create jobs, which can help boost market confidence. So while government interventions can lead to short-term stock market rallies, the long-term effectiveness depend on the depth of the recession and the success and the overall success of the policy in place. Please like this video and don't forget to subscribe to this channel if you've not done that. Number 6 is bear markets and long-term trends. Bear markets and long-term trends. Recession often trigger bear markets characterized by prolonged decline in stock prices. That's it. So in the initial stage, you discover that markets may react with panic selling, followed by a period of consolidation as investors wait for clearer signals, of a likely recovery in the economy. Despite short-term losses, stock market often recover. They often recover after a recession, as the economy begins to recover. So once the economy starts to recover, the stock market will equally embark on the recovery trajectory. And moreover, long-term investors potentially benefit from purchasing stocks at lower price during downturn. Generally, for those who have the cash, in a period of economic downturn, when stock prices are low, that is the right time to buy stocks, with the expectation that when the economy recovers fully, the stock prices will generally increase, will rise in tandem. And so number 7 is sectoral impact. Sectoral impact. So different sectors are impacted differently during our recession. They behave independent. There's no correlation between different sectors, when it comes to economic recession, because they behave differently. So if you consider a sector like cyclical stocks, you discover that industries that rely heavily on economic growth, example retail, automobile, and luxury goods, are more sensitive to recession and tend to underperform during economic recession. Whereas sectors like the financials, you have banks and insurance companies and other related companies, banks and financial institutions may struggle during recession due to increased default on loans and reduced borrowing activity. While others may benefit from government interventions and lower interest rates. So in terms of a recession, you discover that banks will struggle, and other financial institutions will equally struggle because people tend to borrow less because of lower borrowing activities. Number 8 is a recession impact on valuation. Recession's impacts on valuation. In the early stage of a recession, stock prices often fall as investor sentiments turns negative, leading to a lower valuation across many sectors. So the negative sentiment by investors will cause prices in many sectors to plummet, to decline. So, however, companies with a strong fundamentals may present buying opportunities for long-term investors at discounted prices. So valuation may adjust as investors rises and as investors tend to reassess earnings expectations for companies, with some stocks becoming undervalued if the recession is perceived as temporary. Generally in a market downturn, those who have the capital, who have the cash, can benefit by buying stocks at a cheaper price level. And so this is how recession impact the stock market. Generally, in times of recession, the market tends to uh, go on a downward trajectory.